So I used to get on the charts on the live market and I would feel absolutely lost. I didn't know whether the price is going to go up or it's going to go down. And I would take trades and I would lose them. I would take those trades based on the strategies, but it was too complicated. I would have paid indicators and it would mostly fail. And if you're in the same space, you know exactly what I'm talking about. And if you're new, welcome. I'm going to save you a lot of headache and pain. Basically, most traders don't lose because their strategy is bad. They lose because they never actually test it. In this video, I'm going to back test one simple idea with no paid indicators. I have some indicators, but they're free indicators. You don't need them, but they are helpful indicators. And show you exactly what I look for with the wins and losses and break evens. So I went on November 1st. So we'll go ahead and start the backtesting right away. Oh, before we move forward, I'm gonna give you a breakdown of the strategy. So a very simple strategy called candle continuation theory. I didn't come up with it. It's been around for a while. There are people that make videos about it, like Cramson Capital, and it's very similar to Trades by Sai, where he teaches indication, correction, continuation. I will go over it. So, for example, these two candles, they don't necessarily have to be back-to-back green candles, but I'll show you further. But if it works better if it's two back-to-back. Can be daily, 4 hour, 1 hour. On a 15-minute, 5 minute, 1 minute is your entry. You just match it to the time frame, and you just draw your POI based on the previous week. And your entry model is very simple. You either get an inverse for rally gap, closing above the POI, inverse for rally gap, or engulfing candlestick, or both, closing above the POI, which is the most important part, which is indication is going up, correction is going down, continuation is going up. On the higher time frame, you can trade either of them, either the correction or the continuation or the indication. That's pretty much the gist of the strategy. Yeah. So indication, correction, continuation, same way if the market is going down. So this is November 1st. We're on an hourly candle. So we kind of look at the daily candle first. So we went ahead and take out the all-time high and start going down. This is November 1st, by the way. For those of you that don't know, these are my free indicators. The daily range dividers, the sessions indicator, alert on candle close. You need this for live market. So whenever you set an alert for when the candle closes, whether if it's a 1 hour, 4 hour, or daily. Sometimes I set it on 5 minute candles too. And this one is ICT higher time frame candles. And I set it to 1 hour only. So whenever I go to 5 minute or 1 minute or whatever, it'll show me the previous couple hours of candles. That's it. So let's get right into it. So right now we close the market on a downward move, and we didn't take out this previous day. So usually the previous day is a good area to target for your liquidity. So let's see if we're gonna hit it. And we had two closing candles back to back. So we go here to here. We make it a POI. And you go down to your 5 minute. And let's see how so we opened up gap. So we gapped up towards the upside. So whenever we gapped up towards the upside at the beginning of the week at the Asia session, it usually indicates that we are most likely to gonna go a little bit up, take out some sort of liquidity, and then go down to fill out the gap for the week. And let's go one more. So it looks like we're gonna continue to go up. There we go. So if you're that far into it, I'm going to mark out the hourly. There we go. There you go. So that POI is no longer valid. And that's how I see it. That's how I think about it. I'm like, okay. So we closed above. First of all, we gapped up. Whenever there's a gap down, we are most likely to go down. When there's a gap up, we're most likely to go up. So, and then after this, you just do this. That's your POI. That's another thing. When it gaps up, the previous candle doesn't really matter. And once this one closes, you just draw your POI. You go down to your 1 minute. Let's go to 5 minutes to make it quicker. And this would be the drawn liquidity. So yeah. So whenever, like I said, we gap up, you just look for the candle close above. So this was the top of the previous candle. We just draw our POI. If we come down below it and we close above it, we just target the nearest liquidity. So we close below it. And we're going to see if we're going to close above it. Right here. So we have all three of our entry model. So we got our inverse for value gap. And we engulf this candle and this candle. So we just enter here. Say, for example, you enter with 3 contract. That's your full take profit. And your stop loss goes below this swing low. So we have a very tight stop loss. Just in case the price comes down. Sometimes the price comes down. Take out more liquidity. And then it starts to go back up. Just in case that happens. So we'll see what happens. It looks like we're going to hit our stop loss. There you go. So that's the beauty of this strategy. Your stop loss is so tight that even when you lose, you don't really lose much. That was only 25 ticks. And then we close above it. And the second time around, I usually put it on the most recent swing low. Or I put it like right below like one of the swing lows. Sometimes I don't put it on all the way here, but that's where you're supposed to put it at the most recent. And if you want to go for a 1-to-1, it's 48 ticks. You can go for 48 ticks right here. Or you can put your full take profit at the liquidity area. And then sell 1 or 2 of your contract at the 1-to-1. So kind of like that. There you go. So that was our first take profit. That was it. So whenever you're halfway through it or you have your first one-on-one R, then you move it to break even. And this is a strictly for if you're doing an intraday or scalping. If you're doing a swing trade based on hourly to 15-minute or 4-hour to 5-minute, then in that case, you don't necessarily need to take a one-on-one. This is mostly works on if you're intraday or scalping. You want to take risk off of your trade. Either take 70-80% of your trade off, or take the full trade off if you just want to do a quick scalp. And let's see if the rest of it will hit. There you go. That's the rest of it hit. And that's it. There it is. And then you are just done for the day. Quick one-on-one. And you see how we always go and hit it. So this is a little bit more advanced. Same goes with the new day opening gap. It doesn't necessarily have to be a new week opening gap. If the new day opens towards downside, we're gonna go hit the nearest liquidity. If the if the day opens gaps up, you just wait for the hourly to close, you draw your line. If it closes above it, you just get in. Technically, in that first trade, I could have put my stop loss below this swing low, but I was very aggressive with my... I'm usually very aggressive with my stop losses. So I don't... Because when you're scalping or intraday trading on a prop firm, you don't want to lose a lot of money because it stacks up. So you always want to take a defensive approach when it comes to that. So that was one trade for the Asia Open. Let me see if I can go to like a London Open, so I can show you guys a London example. Oops, not there. There we go. London opens at 3. We'll see. There we go. There's our... So London opens, go up. Then you want to wait. There we go. We opened up again. So we have... I believe we have 2 targets. We have here. Oops. And we have also here. So those would be your target. And we already hit this target. So whenever there's 2 candle close and there's already a liquidity that got ran through, I would trade it with more cautious, because I'm like, we already got through here. We have a imbalance, which is the gap to fill out. So I trade with more cautious. So let's go here. And then usually the way I do my POIs, I usually put it through like the most recent one. And I kind of space them out. So kind of like that. So I leave like equal levels, almost equal levels, because there's more wick that you can select, but just divide them up within the logical distance, and you'll see. So this is the area that we like the price to come down below it before it goes up. So you go down to 1 minute. And now on the 1 minute, if you see you have like equal swing lows like this, you can also mark these if you want. And you just set your alert. You just go to your alert. You set an alert on this line, and then you just wait for it. Just wait for the price to come down. And if the price doesn't get there, it's okay. The biggest thing with this strategy is not to chase. If you chase, you lose. It looks like we are going to hit our objective. Oh, that's another thing that I just missed. So here's another swing high. We close below it, and then once we close above it, you could have gotten here and then just take that one. But that would have been a loss, possibly. Let's see. Boop, 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 boop. So yeah, I think eventually we're gonna go hit that. And then we just chopped around. So after an hour or so, if it doesn't hit, it doesn't hit. So you just gotta move on to the next session. So I tried to take one on the Asian session, but I couldn't. Yeah, so we did hit it, but we didn't get enough retracement on any of these to get in to go hit that. So let's go for a New York session. So we are in a pre-New York session. So this is the 8 a.m. candle. We already took that liquidity. So we're either going to go hit this or we're going for this. So let's see. We got a massive rejection candle. So whenever you get a red candle like this that closes below a certain wick and the top of the candle is doesn't really close above it or slightly below it, is kind of equal. This can also be a start of the downward trend. It's better to wait for 2 candles, but if you see something like this, you can kind of start getting in. So what I'm gonna do, I'm gonna put this one here because we went all the way up, took out this liquidity in this area, and we had a massive rejection towards the downside. Let's go down to your 1 minute. Let's see. Let's just checking daily real quick to see what the daily look like. Down. There's that. I go to the 1 minute. Okay, let's see. So you want to draw this line as well. That's why like this indicator is a little bit helpful, because when you draw your line, you know exactly where you're drawing it. There you go. Come up. There we go. We'll close above it. We're closing below it. There we go. So this is a very small scalp. So we close above the POI. We close back below it. And we also got an inverse gap. You don't necessarily need an inverse gap every time. But if you close below the POI and inverse it, it's too good to pass on. So you can do a quick, oh, that's going to be actually a good one, 151 ticks. And your stop loss is going to be 118. So pretty good risk to reward ratio. We'll see if it's going to hit. There you go. So you entered here in 1 and 2 minutes. In 2 minutes, you're done for the day. That's why you always monitor the most recent swing low, especially if they're equal swing lows or swing high. If you draw them and if the price closes above it, close below it as an engulfing candlestick or an inverse value gap, or both of them, is a strong indication that we're going to go hit that nice and base level hit. 151 ticks on a micro with a couple of contracts, you make $300. And if you're trading a mini, that's about 750 on one contract, on one mini contract, and about 2 contracts will be 1500. So if you have a 50K account on a top step or any other one, it's usually 50% consistency. You already hit your 1500 for 50% consistency rule, and you can just do the same thing tomorrow. And I kind of skipped through it a little bit quickly because I wasn't expecting it to hit in under 2 minutes. Usually when the price goes about halfway through, I move my stop loss to either close to the most recent swing or to the break even. But we hit it within 2 minutes. I didn't even need to do anything. There it goes. So far we took 2 trades on Asia. We had no good opportunities on the London session, and we took one trade for New York session, and that's it. We are pretty much done for the day on that one. So this is how you backtest. I hope my thought process and the way I'm thinking about it was helpful. So let's go back to hourly. That's how I like recognize how or when to trade. And once you get both of them, you can also go for another one as well. Go like this. But you have to be very careful, because if you do it like this, we have already hit this area. So if you already taken out a certain liquidity, we may not continue. But more often than not, price goes and get either close to it or hit it again, but it's not guaranteed. So you have to trade it a bit cautious when you see a liquidity is already taken, because the probability is going to be very very low for that liquidity to come down and gets hit again. So let's go do one on the gold. So let's go on gold. Let's go the next day. Let's go November. Let's go at midnight. Or let's do one at the Asian session, at the beginning of the Asia. There we go. Let me go to let me see if there you go. Yep. You look at the daily. There's nothing good on daily. You go to 4 hours. Nothing really good on 4 hours. We're just kind of chopping around. And we are on a downward spiral after taking the all-time high. We gapped up for the week, went down. See, like a prime example. We opened with a gap beginning of that week, and we start trickling down. And now we're going back up again and not taking any of the previous low. So that's a higher time frame thinking. Okay, we're going up or we're going down. So we already had our higher time frame correction, and it looks like we're gonna go up. So let's see what happens. So that's how the Monday closes. Let's see how this one. So we closed towards the downside. So we have our 2 candle formation. Did we take out any liquidity? No, not really. We already fill out this previous day gap, which is also the weekly gap. So we already fill it out. So this is a little bit of a low probability setup, and we already took out all these lows. So if you're gonna short here, you don't want to target here or here. You just want to target this, if there is even a setup. So you go down to your 5 minute or 1 minute. We'll see if we're gonna get a downward movement. Let's see. We also have these kind of sort of equal lows that we broke through it. No, that one doesn't count because that one didn't quite close below this one. So that one is not valid. And it's very important not to force it. Because once you get in it, it's such a simple strategy, but people start trying to force it. If you don't get it, you don't get it. You just move on. There you go. See what I was saying about the liquidity usually gets hidden twice. That's what I meant. You can kind of see that the price wants to get to this area, but it doesn't. So you don't want to chase the trade. You don't want to get somewhere around here, and then the price comes and hit this area, and then go down that way. See what time is it? 1946. There you go. Let's see. So the new candle opens up. You see this hourly? We closed below. Didn't quite came and touch this area. And we went down, and it's going back up again. Because we already took out that liquidity. We don't really need to go any lower. So that one is no longer valid. Let's see how this hourly candle closes. I'm going to put it on 5 minutes so we can go through it faster. This one closed again. Didn't close below any of these. The body of the candle has to close. That's another thing people were asking. And we got a doji candle. We'll see if this one closes it. So we go back to the hourly candle. This is another like really nice candle pattern that shows a reversal. If you they call them like these are called doji. These are called like hammer. So if you see something like this around the same area, it's a very strong indication that the price is about to shoot up. So we didn't get any good entry on the Asian Open. So we're gonna see if we can get something at London. Nice. So below it, come back above it. So there we go. So close above it, beginning of the London session, the pre-London session, I guess you can say it's at 2 a.m. So we do it like this, go to that line. Then we close above this, above this. Do we close above this? No. So this is our area of support. And I'm doing it in one Asia, one London, one New York. Because in the previous videos, everybody was complaining that I didn't show enough for London session and Asia session. So that's why I'm doing it this way. Let's see. Let's see. The next hourly candle is about to close. There we go. So that candle closes it. But the thing is, as you can see, the body of the candle didn't close, almost close above the previous week, but not by a big margin. So when I see something like this, I usually stay away from it. But let's see if it's going to give us any good setup. Let's see. You always want to like monitor the previous swings too. If there's multiple swing like this, there's a multiple swing like this. And what do you see? If around the same area, price gets rejected, there's most likely that we're going to start going down to grab more liquidity before we go up. Or if the price breaks above this area, then you either want to just get in right away to target this swing, or just wait for it to come back around this area and then go back up. A little bit of support and resistance teachings. Let's see. So we are monitoring this area. Monitoring this area, we're monitoring this area, see if we're gonna close above these. The price is struggling. So this is 5 a.m. So by the first 2 hours, if you don't get anything, you're pretty much done for the day. And the beauty of the strategy is you just put an alert. You don't need to be at the chart 24/7. Sometimes you get it like way too late. So you get it around here, but it's a little bit too late, I would say. And the price didn't really quite close below it. So this time closed below it. So we finally got there at like 5 a.m. for example. So close below it. And right away we closed above it and we engulfed that previous candle. So you can technically get in this one, risk maybe 2, put your stop loss right below this swing low, and then put your take profit at this area. I like to color code mine. And then you let the price do its thing. And then in my mind, I have a break even area. But if you forget about your break even area, so usually either halfway through or at the most recent swings. So let's say between these two swings, I wanna put a break even. So you just do like this, and then you write down break even, and then you set an alert. As soon as the price hit it, you have two decisions: either take full profit or put it at break even. It's really up to you. It's very discretionary. By then, you're already over your 1-to-1 risk to reward ratio, so you can technically take it off if you want. So that's how I think. That's usually the best way to do it. Here we go. So in this area, since you're over your 1-to-1, you're at your break even, you're in there with 2 contracts. So you can take 1 contract off. So click on sell. So I take 1 contract off, and then I move my remaining stop loss to a right above the break even. So that way you're protected, or you can be very aggressive and move your stop loss at every time a 1 minute candle closes it, just put it below the most recent swing, most recent candle close. So that's how I do it sometimes. You don't have to be that aggressive if you really believe that the price can hit. And most often than not, the price will hit it. Just a word of wisdom, I guess. There you go. So let's see if the price is going to hit it or not. There we go. So if the price hits the most recent swing high and has a strong rejection towards the downside, it's also not a good sign. That's when I move my stop loss even more aggressive to see if we're gonna hit it or not. And once the price start like struggling to go back up to take that area again, then that's when I either close it or put that break even. So hopefully that was helpful. Because if you're bullish, we shouldn't just come and take out the most recent swing low, and we should just go and close above it. A little bit of piece of nugget. If a closing is twice as big as the previous most recent swing, we are most likely to gonna go up. For example, in this area, we took out this most recent swing low, and we closed almost twice the size of it. And when it comes down to back to this area, then it goes back up again, almost make the twice the closing the size. Comes back to that area again, because times are fractal. If it applies to 1 hour, daily, or 4 minute, it also applies to 1 minute. It's also a good way of to set a limit order. For example, like this swing to this swing, what do you see? Close above it, twice the size, came back below it, has to close below it, and then one above it, almost twice the size again. Kind of a little visual pattern recognition of what you're looking at. Sometimes it comes in naturally, but sometimes it takes years for you to see it. So hopefully that was it. So that was your, I guess you can say, London session trade, and that's it. So usually I take one. If I win a trade at a session, I'm done for the day. If I take two losses, I'm done for the day. If I take two break evens, then I trade the later session or the PM session of the same, and I'm done with it. That's how I think about it. That's how I see it. Because if you're in the market too much, you're more than likely to lose. And with this strategy, the beauty of this strategy is there's either a setup or there's no setup. It kind of prevents you from over trading and revenge trading, because if the price doesn't come below that line, and the price is not gonna do this. Let's say, for example, you have something like this. You have this area. That's what I mean when I say you're not gonna be able to revenge trade with this strategy. Let's say you have something like this. The price will almost never will do this. Like, the price doesn't do this. Sometimes it does, but most often than not, it doesn't do that. That's why you have that two loss rules, which I rarely ever hit it on the same POI. Because the price usually doesn't just dilly-dally around the same POI. It either start going down the other direction or it starts to go up. And that's why you have the two loss rule. So if you lose twice within the same area, you're just down for the day. For example, you're not gonna see 1, 2, 3, 4. You're not gonna see like 4 bad chops, and then after the 4 bad chops, it's gonna go to your liquidity. Almost never happens. You can backtest it, you can see it for yourself, but in my experience and what I've seen, it rarely ever does it. So let's do one more for the New York Open. Let's see, Mark. Let's do the 8 a.m. pre-market. Ooh, closed below this and below this. This was the first POI. If you would have traded, that's another thing. If you see a massive rejection around the same area, we eventually gonna go down the other way. So that would be our liquidity. So this is our area. Just copy that. That's our area as well. So they're kind of close to one another from here to here. I don't really want to see the price comes all the way here, because the price, as you can see, we already came to this area to take out this. So what I want to see the price comes here or here, or maybe here. If it starts going above that, I usually don't take the short. That means we're reversing the other way. So let's see if we have any good setup that may appear. Nope. We already hit that area. And I don't see any other good area of the liquidity that we need to hit. We have this area, but I doubt we're gonna go hit it. Let's go to the hourly. That one already closed. There you go. We got that doji candle. So So we got this nice and doji candle after taking out this liquidity. So if the next one is green, we're most likely ready to come hit it again and then go back up. Let's see. There we go. That is our clue. Because we already hit this area. We got our doji candle here. Took out all the liquidity here. So now we are ready to go burst through this. Let's see if we get a if we get a trade. Actually, 11:57. Nah. Let's see. Technically, we already closed below it, and we're going back above it. So, see. So we close above this, came back to this line, close above this, came back, close below, close above it. I kind of want to get in on this one. I'm gonna make an impulse decision to get in. Put my stop loss at this most recent swing. Put my take profit at this. Is it a 1-to-1? Slightly above 1-to-1. Let's see what happens. See, that's why. That's exactly why you wait for the confirmation. Because see, we didn't close below it after the hourly candle closes. Just a prime example of why you need to wait. It almost never fails. So that's all you need to do. You need to just wait for it. And then by this time, what time is this? 13. And we had a candle closed, this candle closed. And then this one closed right here. So, yeah. So let's see if we're going to get anything. No. So at this time, I'm just down for the day on that one. So, yeah. So hopefully that was a good example of why you need to wait. And this is a little bit of a low probability setup. When you see price kind of tricklings up, doesn't really close significantly above the previous swing, that's how you know you kind of stay away from this. That's why you wait. For example, this one is clean. So when you see a clean break, come down, and then clean break and come down, that's how you know you got a good one. Sometimes you don't even need to look at the hourly. If you go to the 1 minute, after it's taken out the massive liquidity, you kind of want to like put it somewhere at the beginning and the closing of the wick, something like this. So like you know what? Did we close cleanly above it with like not like forcefully, but clean, close, clean, and then trickles down below it, closed above it again, and you would have gotten here, put your stop loss right here, very tight stop loss, and then just target this most recent swing. Nice 1-to-7 over 1-to-1, or you can target this area, which it would have failed to hit, but if you would have dragged your stop loss, you would have gotten more than 1-to-2. So yeah, I don't want to make this one any longer than it already been. Hopefully that was helpful. I think I answered most of the question of people from the previous videos. I did gold and NQ. I don't have enough time to do forex pairs and cryptos, but those are the main ones that people trade. People trade NQ and people trade gold on the futures market, and that's what I prefer to trade on prop firms. That's what like almost 95% of people are either transitioning or trading. So hopefully that was helpful. And you can find this entry model in the community. You can join. We have over 600 members here. I'm going to add a lot of content in here. I'm going to add more entry model, weekly outlook. I'm going to add backtesting sessions. And we also have an upgrade session if you're new or intermediate and you feel like you need more one-to-one sessions or more in-depth lessons, you can upgrade it, but you don't have to. This is a free group. This is a community that I wish I had when I started it, and it's completely free. If you do need something more, then there's an upgrade version for you as well. So, love and peace. Talk to you guys later.